And now for the commodities market update, we have Dumebi Oluwole, Senior Analyst, Financial Derivatives Company, joining us via Zoom. Dumebi, great to have you. Good morning. So it's official. The CBN has introduced the willing buyer, willing seller model for the ironing window. And Mr. Ebo did, highlights the benefits and also the negatives. So tell us how this unification affects commodity prices and food prices right here in Nigeria.
So the first thing to actually consider when we look at the exchange rate unification process is that what exactly is going to happen right now is a swift convergence between the official rate and the parallel market rate, meaning that the exchange rate, which is the price in the Forex market, will trade closer towards the market determined rate, which is the black market rate. So anything between 600 to 751, that's where the exchange rate will trade. Now, the other thing to also consider is that what this means for Nigeria's exchange rate and regime and entire exchange rate system is that prices will be more reflective of what exactly is happening with Forex demand and Forex supply. Now, on the part of Forex demand, what we'd likely see is that demand would be consistent, right? Because the issue with the Forex market has been that supply has not been able to meet demand. And then it also means that companies, individuals, and also the government will access Forex at this market determined rate. Then we also look at, then from the supply side of it, what's going to happen is that there are a few things to consider. Number one, we would likely see an increase in supply of Forex, at the I&E window, which is now going to be the official, rate, because most likely, eventually, we would not have a black market rate anymore. But right now, that is still going to exist because there's still the Forex ban in place. There's still a lot of things to consider before we move towards a completely unified exchange rate. But like I said before, convergence, a very swift convergence, is what Nigerians are going to see, what businesses are going to see. So then, like I was saying on the supply side of things, we have to consider what exactly makes a Forex supply for Nigeria today. And that is, number one, we look at oil, crude oil revenues. And what exactly is happening with crude oil revenues today? We're seeing that our production levels are still suboptimal, meaning that Forex supply will still be thin from that particular angle. So the expectation here is that as the government is making this move towards unifying the exchange rate and making it more market reflective, what we'd likely see as well is that what analysts also expect is that there will be commensurate efforts towards improving crude oil production so that we earn enough Forex to increase supply significantly, even though there is now the willing buyer, willing seller model. Then we also have to consider the fact that FPI inflows and FDI inflows make up a significant chunk of our Forex supply as well. And we're already seeing that FPI investors, FPI inflows would likely increase. We've seen what's happening with what has happened with the NGX that has gained almost 7%. We've also seen what's happening with Nigeria's Euro bonds and also our bonds. So that shows an increase in investor sentiments and confidence towards the Nigerian economy. And we could see FPI inflows trickle back into the economy. Same as well with FDIs. Although with FDIs, the government will require a lot more push towards encouraging Forex inflows from that angle. Then we look at remittances that also make up our Forex supply, right? With everything that is happening now, the expectation is that cross-border transactions between Nigeria and other countries will be easier. And that clearly means that remittance inflows will be easier to push into the country, making further supporting our Forex supply. So netting the effect, what we'd likely see is a more market-determined exchange rate, a significant increase in Forex supply, pending when the government, support or increases efforts towards encouraging or boosting crude oil production that makes a significant chunk of our forex supply. Depending on all of this, what would likely see is supply will begin to meet demand. The market, the forex rate itself, which is the price, will be will be more reflective of demand and supply, trending towards what the parallel market rate is today. That is around 600 to 751. So that's what would likely see. Yeah. As for how businesses and consumers, how the impact of this. So for businesses, already businesses have been using a blended rate, right? Manufacturers have been using a blended rate to access to get forex. We've seen reports of them saying that 90% of their forex needs have been gotten at the parallel market rate. So what this means is that there's really not. We won't see so much change in the price at which they will get forex, because that's already what they get forex at. What we would see is a change in their accessibility, meaning that forex supply would now meet their demand.
And accessibility is basically what we need right now.
Exactly. So there will be less need for panic buying and speculation because there's increased transparency. As for prices, not all commodities have the exchange rates that have the exchange rate influencing their price, right? So just commodities like pasta, noodles, wheat, foreign rice. So those are the commodities that will definitely see an uptick in their prices just because of this change in exchange rates, so that's where the impact on consumers and businesses would land.
Yeah, so much to unpack there, definitely. But let's look at the inflation story now. We're expecting inflation data for May later out today. We're currently at 22.22%. How is this going to play into inflation data for June? Seeing that is in this month we had the subsidy removal, for PMS, and now we have the unification, of exchange rates. How is this going to play into that inflation story for June specifically?
Yeah, Ladi, thank you very much for that. I think you're already becoming an analyst at this point.
Right.
Yeah, so clearly you're very right. All of this will be more pronounced in June inflation numbers. So as for May, what would likely see is the impact of, like the planting season and how, the just the immediate impact of the fuel subsidy removal, because remember that the fuel subsidy removal actually happened 3 days before the end of the month. So we could see a minimal impact, of that on inflation, on prices, just this in May, but in June it will definitely be more pronounced. Same as well for the exchange rate unification, and the expectation is that it will definitely, cause inflation to spike. Already there are predictions that the fuel subsidy alone will add between 2 to 3% to inflation rate. From what it is today. So those are the things that we expect for June inflation numbers that will be coming out soon. So food inflation, yes, we'll see an uptick there. Month-on-month inflation, we'll definitely see an uptick there. Same as well for core inflation, and this is because PMS prices have increased. Transport fares also have increased as well. So that's where inflation would settle for June.
Yeah, and talking about inflation, we know the central bankers have been, battling inflation since 2022, and we see the U.S. Fed, for the first time, they've paused rates at the meeting yesterday. Obviously, investors were excited and expected that to happen, but there was also some bad news there. They expect more rate hikes going forward, and I'm sure that's what rattled global markets yesterday.
Yes, that did. But analysts right now are playing the wait and see game, just trying to see how well this pause will actually take effect on the economy. So essentially what the US Fed is saying is we're pausing rate hikes now just to see how well what we've done in the past 10 months will take effect on the economy. The expectation is that prices will begin to reduce a lot more, and also they're trying to refrain from causing the economy to overheat, and that's because the monetary policy transmission mechanism in the U.S. is really strong. So when interest rates increase, that's when the U.S. Fed funds rate increases. We see a significant uptick in the rate for commercial papers, treasury bills, mortgage rates, savings rates, all of that. And remember that we're also coming from the recent agreement for Biden and for the Republicans and Democrats as well to stop the U.S. debt ceiling, so the U.S. doesn't go on a default. And there were conditions that came with that, meaning and one of the conditions was that student loans as well, all of the freebies that came with the Biden administration will be halted, at least in the interim. So meaning that people that were getting palliatives and all of that, we would see a significant decline on that. So the expectation is that with this pause, we definitely would see the impact of the rate hikes take effect on the economy, because the expectation is that inflation might actually increase. But now that the U.S. Fed decided to pause rate hikes for now, we would see at least business owners and investors just take a little breather in terms of like the cost of borrowing that is already high, and the likelihood of the U.S. economy overheating is already significantly down just based off of this pause. But right. Because the U.S. Fed is considering tightening, it's coming from that decision to pause the debt ceiling just so the U.S. doesn't have a default. The U.S. doesn't default on its loans, and then the implication of that on inflation, because people will end up, student loans that were, paused for some time. So all those interest payments are going to come back up, and definitely would bite on consumer disposable income. So that's where the increase in tightening as well, or the stance to continue tightening is coming from.
And I'm sure the banks in the U.S. too would also feel some kind of relief from this pause. But let's tap in on the oil markets now. We see oil prices are down today. What's driving sentiment?
Well, generally, it's coming from the U.S. Fed's decision. So markets are weighing that. We're also seeing what's happening, like tensions between the U.S. and China. That is also having an impact on prices. We've also seen news about U.S. crude inventories. So all of this combined are driving sentiments around crude oil prices. In fact, oil prices have actually been volatile in the past few days, and another but mostly tilting towards bearish sentiments. Goldman Sachs, that's usually very optimistic about oil prices, is projecting a further decline in its forecast for where oil prices will eventually settle at the end of the year. So there's a lot of bearish sentiments pervading the oil markets, and all of these things that I've mentioned are exactly what the things that are fueling sentiments and why oil prices are trending downwards today.
And I'm wondering what the Saudis are going to do about getting these prices back up. But we'll keep watching. I'm sure they have something up their sleeve at this time. But thank you, Dumebi Oluwole, senior analyst, financial derivatives company. It was great having you today. Thank you.
Thank you so much for having me.